Hey folks, good evening and welcome to another Money Space with me, Kalu Aja. Apologies for the voice, if the voice is kind of croaky, recovering from a cold, so we're going to try our best today to get through it, but thank you guys for being here. Today we're going to talk about building wealth using equity funds, right? And I advertise this as a space for the very, very young, below 40. You guys are going to understand why I use that title and why I'm looking for that demographic as we go along. But everyone can join in, and we're going to take our time today. I've got tons of time, even after the presentation. As long as you have questions, I'm going to be here to take those questions and try to answer them. So we've got time. Also, the space is going to be recorded, so it's recorded on Twitter. But obviously, I have a podcast, so I'm doing this cross recording also on my podcast. So once the space is over, you can go to the podcast. The way I see it is going to be recorded there. Also on YouTube. So if you're on YouTube as well, it will also be recorded on YouTube. And YouTube, of course, has the great visuals, right? So that way you can sort of follow as well on YouTube. So we've got those three ways that you're going to have to get this recorded after. And I think they're all going to be fantastic for you guys to follow once we're done. So we're just going to start. It's like I said, it's going to be, I want it to be more of like a, what's the word? Like a masterclass style presentation, right? We're going to take our time and walk you guys slide by slide what we're trying to say, what we're trying to communicate. So you guys get exactly, you get the learning I want to communicate today, right? So I'm going to be sharing from YouTube the slides onto Twitter, but I think YouTube is just going to be the best place for you to get the to see the visuals. So if you go on the TL, I did share the link to get to the YouTube, and you can just go over there. So let's just start off. The title is called the Rip Van Winkle Portfolio, i.e., who is Rip Van Winkle? If you know, this is a guy that essentially went to sleep for 20 years and woke up after 20 years. He did nothing. He just woke up after 20 years and essentially he was awake. 20 years had gone past. So the way I'm looking at this is that if you had to invest money for 20 years without touching it, without doing anything at all, what sort of portfolio should you build? Which is what we're going to talk about today. That's how we said the guys that are below 40. Because below 40 implies that you have a long compounding period. Investing is all about compounding. That's the secret sauce of investing, they don't tell you. Albert Einstein said compound interest is the eighth wonder of the world. What he means is the compounding of interest. Warren Buffett is worth billions today because he's compounding. The folks that get money and lose the money, like maybe they play sports or they are actors and they get money and they lose the money, they lose money not because they didn't invest, it's because they didn't compound the returns from their investing. So compounding is the secret source of investing. And this Rip Van Winkle portfolio is talking about how can you compound. Because once you learn how to compound, you then learn, of course, how to generate wealth. It's as simple as that. So our next slide, we are now talking around how is wealth built. If you're on Twitter, just follow the slides on Twitter or on YouTube. I'm sharing them as I speak, right? So we have this great infographic here on how to build wealth. And this is the same in any country, for any demographic, for anybody. This is exactly how wealth is built in Nigeria, in the US, in Russia, in North Korea. Wealth is built this exact same way. If you look at the diagram, you see a big circle called earn, which means you've got to earn money You can't invest or become wealthy if you don't earn money. Let's use a bad example. Even when you steal money, quote unquote, that's earn money. You've got to get money. Right? If you're a pirate and you are earning gold from robbing other ships, that's earning money. If you're an entrepreneur, inventor, you work, someone pays you a salary, you're earning money. And you see those two little boxes there. You got the spending money, you've got the saving money. That's where the problem is, because when you earn money, earning is not wealth. You've got to spend. Spending is you've got to eat, right? So you got to eat, and after eating, you've got to then invest, right? But that's where we run into the problem. That's where you have most of these financial courses teaching you how to spend and how to save, right? And of course, also how to earn. The simple way to get wealth is to spend less than you earn. Because once you spend less than you earn, of course, you then have a surplus that you can invest. And if you invest over time with compounding, then you then create wealth. So it's the same formula across the world since the beginning of time till today. You want to start to earn early. Then you want to spend less than you earn. Then you want to invest that balance so that it can compound for you. It's really that simple. You've got to earn, you've got to spend less, you've got to invest. And all these simple sentences have got a whole body of knowledge around them, which is what we want to get into today. So it's a very, very simple process really that we're talking about, right? Let's go to the next slide. And again, this is good why this is going to be a recorded slide. So even in your free time, you can go back and really take your time to listen to this presentation and to get many things that you would not have gotten this first time, right? Again, if you can't see it on the slides on Twitter or YouTube, just holler at me, right? Holler at me and I can get this back for you. Now, we talked about investing, and we said when I advertised this, I said 40 years and below. Why 40 years and below? Because it's about compounding. Investing is really a story of compounding. Compounding means interest on your interest. So look at the slide we're sharing. The cost of delayed investment. This is from my book, Let's Talk About Money, or page 71. If you delay, look at, if you delay your age, there's a delay / your age. So if you start to invest 200 naira at 7% from the year 20, in 65 years, you're going to have 239,000 naira. So if you just go to your PFA and you say, hey, PFA, take just 200 naira. So if we make it 2,000, we're going to get 2.3. Just take 200 or 2,000 from my salary, my paycheck every month, and invest it at a minimum of 7%. In 65 years when I retire, because you're 20, so when you're 65, when you retire, you're going to have 2.3 million. If you do 20,000, 23 million. It's your call. But again, spend and save. But what if you delay? If you don't start to invest when you are 20, let's say you start to invest when you are 35, the same interest rate, look at the same interest rate, but you're going to get only 82,000 naira at 65 years old. So both of you go into the same company, both of you get paid the same amount of money, but you start to do your RSA investment, your retirement savings account, or you had an investment portfolio, or you put money in the bank at age 20, or even at age 21, or at 25, you will have more money than the same person investing the same amount of money, same interest rate, but he just started later. Look at the middle chart. If you start investing at age 25, you're going to get 170,000. So if you do 2,000 naira, that's 1.7 million. Again, if you wait till you are 35, you'd only get 82,000 naira. It's the maths, guys. The maths, how we calculate inflation and how we calculate compound interest is based on time, not the interest rate. The interest rate of 7% is not the issue. The real issue is the time you start to invest. Like I told you guys last week, go to your banker, ask your banker, show me the calculation. How do you guys calculate interest rates? If they show that to you, you're going to see it's going to be over time, raised to power time. That's why time is the most important feature in your investment journey, not the interest rate per se, but how long, how early you start. That's going to be the kicker for you. So that's why if you are below 40, and I told you guys to come to this space, if you're below 40, you will have an advantage, built-in advantage, because if you start today, already you have you are going to make more money. Don't look at the naira you are going to make. Look at the return on investment. your ROI is going to be more than the same person investing the same amount of money but started later than you. It's just that simple, guys. It's just that simple. Let's drill down that point again. Again, this is another picture again from my book again. Let's talk about your money. Again, guys, if you haven't seen the slides, just holler. Last week I was going on and some folks didn't see the slide and they hollered a bit later, but I was able to correct that. So again, we're on YouTube and we're also on so we can see the slides. Yep, perfect. You guys say I can see the slide. Fantastic. So let's go back to the picture, to slides. Diagram 1.4, again from my book, Let's Talk About Your Money. Look at these two brothers, and this is a great example. Brother A started to invest when he was 21. He only invested 2,000 naira or $2,000, right? He only invested for 10 years. Only for 10 years. So 2,000 naira every year for 10 years. The same interest rate, 8% compounded. Over a 30-year period, the brother that started to invest when he was 21 has 145,000, about 145,000 naira. But the guy that started to invest when he was 31, even though he invested longer, he has 98,000. It's the same principle. If you start early, you make more money. It's not the interest rate. Literally, this same example, if you double Brother B's investment to 4,000, he still won't meet Brother A. You can try it yourself. If you double the investment of Brother B to 4,000, he still wouldn't meet Brother A. Why? Brother A's monies are investing for him longer. Because he's compounding longer, he's getting more money. So an early start is the secret sauce. That's why the space today was saying, if you are younger, you want to join in. Because when you join in earlier and you invest earlier, your returns, your principal has more time to compound. It's as simple as that, right? Again, I'm drilling this point down again with a different slide. This is again showing you the same thing we showed you, Brother A, Brother B. Look at the graphs. Who has got the highest funds? The guy that started to invest by age 25. He gets the most funds. It's not the guy that started to invest at age 35. That's the guy you see in brown. It's not the guy that started to invest at age 35 and earning the same interest rate. That's the guy in purple. The largest returns, the largest ROI is from the investor that started early. Same interest rate. But when you start early, you make more money because your principal compounds more. If you go to the bank and the bank tells you we're going to compound your interest annually, quarterly, monthly. When they compound monthly, you get more money. The same interest rate compounded daily or monthly would earn more than the same interest rate compounded annually. That's the beauty of mathematics and compounding. That's why Albert Einstein called it the eighth wonder of the world. It's also the reverse. If you borrow money at compounded interest, then your wealth is degraded faster than someone that does not borrow money. So it's also the flip side as well. But when you start to invest earlier, you have an built-in advantage because you are going to make more money because of compounding. So I hope I've drilled that in sufficiently into you guys to say, hey, whatever you're doing, you can't say, I don't have money. You can't say, I want to wait till I get money. You can't say, I want to wait till I marry. You have to start to invest as soon as possible. Somebody's asking me, I'm 45, I want to invest. Yes, you can invest, but you've lost a bit of the compounding advantage. You can still invest, you can raise your principal, right? But you've lost a bit of that compounding advantage. That's the point. But you don't stop investing. So now let's move to the next part of this presentation. How, before you invest, you have to know what kind of investor you are. And why are we asking you to go to the equities market? So if you have the knowledge, let's say you're a banker or you're a stockbroker, so you have the knowledge about investing, fantastic. So look at my flow chart. I have the knowledge about investing, fantastic. Do I have the time? Yes, fantastic. Can I take high risk? Yes. Then I go straight to stocks. You see how the flow chart is going to take you to where you should invest. But let's say I have the knowledge. Do I have the time? No. Am I interested in the cost of investing? Yes. So I go to passive income or an active mutual fund. We're going to explain what passive income, what index funding, and what an active mutual fund means. Don't worry about that. But this is trying to show you that you should invest according to your own peculiar objective. If you do not have the time or the knowledge to invest, then of course an index fund is going to be your best friend. You don't have the time, you don't have the knowledge, but you have the means to invest. An index fund works best for you. But you have the knowledge, you have the time, you can afford to take your own risk. Sure, go and buy your individual stocks. So there is no right or wrong answer in investing. Index funds are not better than individual stocks, but do you have the time, the knowledge? Are you worried about the cost or risk to invest on your own? That's the question you want to ask yourself. And if you get that answer, it then takes you to where we are taking you to today, which is going to be, we want you to look at index funding, equity index funding as your pathway to get wealth. The greatest investor, at least in my lifetime, and I would even argue in the lifetime of modern investing, is a guy called Mr. Warren Buffett. So when somebody is this good in investing, we have to listen to what he says, right? At least to get his sense on things, right? So Warren Buffett said, they asked him, how should we invest, sir? What's the best way to invest? Give us your DNA. He said, put 10% of your cash in short-term government bonds and 90% in a low-cost equity fund. S&P 500 fund here just means equity fund. So the S&P is a fund that tracks the Standard & Poor's index of the top 500 companies in America. So what he's saying is that take 90% of your funds and just buy all the stocks that are quote-unquote big and good in America, and then put 10% in cash in government bonds. Why? Safety. So that's his insurance, 90-10. So Warren Buffett, that does all these sophisticated deals, is telling us, listen, you guys might not have the knowledge that I have. You might not have the time that I have. So I advise you to just do 90-10. 90 in equities, low cost equity fund, and 10% in cash. That's what he's saying. So of course, we basically listen to what he's saying. Should we copy it? But at least let's listen to what he has said, right? That's what Warren Buffett's advice. He didn't say go and buy hedge funds. He didn't say go and buy crypto. This is what he's saying we should do with our funds, which is very, very interesting to note, right? So now, what is an index fund? Because Warren Buffett is saying buy an S&P 500 fund, which is like an index fund. So what is an index fund? An index fund essentially is like a basket, right? You go to the market, you take a basket and you buy all the things you like. You put tomatoes, yam, you put everything in the market in that basket. Then you buy the basket. So you say, hey, you put your tomato here, put your meat, put your fish, put your everything in the basket. That index fund is tracking everything in the market. So when you buy the index fund, you are buying whatever the index fund has already bought. So in the example of Mr. Warren Buffett gave, he said buy the S&P 500, which means that once you buy that index fund that tracks the S&P 500, you have bought a fractional share of 500 of the largest companies by market capitalization in America. Simple. So look at our slide. Investing in index funds might not be all that exciting. Then it says that's the point. It gives you broad exposure to the market, to assets, and would ensure your wealth grows over time. So when you buy the index fund, remember you are buying everything into one basket. Number one, you are buying everything with little amount of money. If you imagine you go to mile 12, you want to buy tomato, fish, yam, tomato, engine oil, rice, all that stuff. I say engine oil, all that stuff. Yeah, how much do you think you take to the market? It's millions. But what if they told you that you could pay 500 naira, and with that 500 naira, they're going to give you one slice of tomato, one slice of fish, one slice of meat, like that? That's what an index fund is. You are buying the basket that contains all those assets already. So because you are buying them, it reduces your cost of buying. it automatically diversifies what you are holding and you are buying it cheaper. So you will not beat the market. So when you buy the index fund, right, you're not going to say the index fund cannot do 10% and the market is doing 5%. It doesn't really work that way. You are going to be in line with the market because the market is doing 20% and you own every stock in the market. So you also do 20%. Get the point? So that's why you should go to, because you don't have the time, the knowledge, of the expertise like Mr. Warren Buffett to start buying individual stocks. So you want to buy the index because the index then shows you, it gives you exposure to all those funds at a very, very cheap price. So I hear some folks have been asking me last week as well, what's the difference between a mutual fund and an ETF? Because they hear me say sometimes buy an ETF, but they go to Nigeria, they see mostly mutual funds. What's the difference between a mutual fund and ETF? So remember, the index fund can buy, the mutual fund can buy the index fund. The ETF can buy the index fund. No difference there. They can both buy the index fund. But what's the difference between the ETF and mutual fund? Really, they are the same. Really, they are the same. The key difference is that the ETF means exchange traded fund, which means you can buy and sell the ETF during the trading day. So if you buy, if there was a stock called Nigeria 30, if you buy mutual fund Nigeria 30, you can only know the price at the close of the day. But if you buy an ETF Nigeria 30 during the day, you can buy and sell those stocks during the day. That's the key difference. The rest is going to be maybe trust deeds and how they are managed actively. Yes, those are all differences, but that's the key difference with the mutual fund and the ETF. In America, ETF also have tax advantages that make it more attractive than mutual fund. So ETFs are the growing asset class in America. In Nigeria, not so. The ETF market in Nigeria is very, very limited in terms of volume. So we have ETFs, but I noticed that the volume of trade in the ETF space in Nigeria is very, very low. And most mutual funds in Nigeria that call themselves equity funds have a huge exposure to also fixed income. So some differences there, right? But I prefer ETFs because of the tax considerations. But in Nigeria, you're going to have mostly mutual funds that buy the index. So again, keep that in mind as well. It's not a huge difference. It's not going to change what we're doing today, right? It's just going to give you the avenue to say, hey, I want to buy equities through this field, or I want to buy equities through that field. Again, this is just a slide just to confirm what we're talking about again. The mutual funds can invest in the index, and also the ETFs can also invest in the index. So any way you want to go, you are still going to get that exposure to diversification at a lower cost. That's what we're going to today. Diversification at a lower cost that compounds. That's the secret sauce today. Diversification at a lower cost that compounds. That's what I'll do today. And guys, I'll be done pretty soon. I want to give you guys the theory of what I'm talking about. And if you guys have questions, just go ahead and request to speak, and I'll add you. Not a problem. I'm just going to add everyone. And then once we're done, we have the visuals. Then we can ask our questions. Like I said, I'm here all day. No rush. I'm recovering from a cold, so I'm going to just stay indoors and just speak with you guys, right? So let's go now to this very, very exciting slide. So Mr. Warren Buffett gave a suggestion that if you want to invest, you should put 10% in a government bond and 90% in an S&P 500 index fund. That's not a sexy recommendation. It's a very, very boring recommendation. He's saying don't trade. That's what Mr. Warren Buffett is saying. He's saying don't trade. Take your money, put it in an index fund. Index fund means it's not going to be trade. Just leave it there. Every year, you make what the market has made. There's no risk. If the market crashes, you crash. The market goes up, it goes up. So one guy, and he put a bet. Mr. Warren Buffett says, I bet you, he said, I bet with the investment community that over a 10-year period, let's put money in an index fund. You guys go put money in your hedge fund. He says, I will make more money. The index fund will make more money than the hedge funds. Hedge funds are the cream de la cream of investing. They are the Nobel Prize guys in finance, the guys that have the brains, that have the knowledge. So if you want to really know who is the 10-pound gorilla in the room in terms of investing, it's going to be a hedge fund guy. But Buffett is saying that if you simply take money and buy the index is the boring replication of just the index, just buy that, you will make more money than all the advisors over a 10-year period, net of fees. That was the gamble, and this guy took up the gamble. Protege Partners took up the gamble. So, who do you guys think won this competition? Did the index fund win, or did the Protege Partners LLC hedge fund win? Who do you guys think won this competition? We're going to find out at the end, and it's going to be very interesting who won, right? But that's the bet that Warren Buffett, who was so sure of himself, he said, listen, I'm not going to tell you what I'm not going to be sure of. I'm going to put my money down where it is. The prize money was $2.2 million, guys. This was not like bet of I'll buy you beer. $2.2 million bet on who would make more money, index funding or going through a hedge fund. And we'll find out who won later on in the slide, right? So now let's come into what I call the number side of the equation. I think I've tried to make the case in the earlier part of the presentation that, listen, you want to start early. Number one. Number two, you want to start early, but you want to invest in an index fund. And that index fund can be tracked through an ETF or a mutual fund. That's what I've tried to explain to you guys so far. So number one, we want to start early. Number two, we want to compound. Number three, we want to invest in an index fund. And that index fund can be an ETF or a mutual fund. Okay, but what do we buy in this index fund, Kalu? What should we buy? Well, to know what you want to buy, you want to look at what has made money before. Abi? Remember, in investing, we say past performance is not a guarantee of future profit. So, full disclosure, I've said that. But we want to see what has happened in the past to guide us, perhaps, or to give us a sense of history. So let's go and look at what has happened in the past. Right now, we hear stocks are down, bonds are, gold is up, and all that. There's a nice chart that shows the returns over 5 years. I can do the work for 20 years or more. It's all going to be the same story. If you look over a 5-year period, the asset class that has beaten inflation and has delivered the highest return, the asset class is going to be US stocks. And in this chart, they're using VTI, they're using ETFs to capture the asset class. So they're using VTI, which is about 4,500 of the largest stocks in America, just America alone, right? Has been the most consistent performer over a 5-year period, has beaten inflation. Which inflation? US inflation, dollar inflation, has beaten inflation and has delivered the most returns over a 5-year period. What's the next one that has beaten it? The next one, commodities. So your gold and all has beaten commodities. But again, look at commodities, it's a recent guy. This year, over the years, it hasn't done that well. Stocks did 17%, 22% over 3 years. So even though today you see US stocks are down, over a long period, over the trend, if you go back to 1928, you're going to get the Great Crash, you're going to get the Gulf War, you're going to get the recessions, but over time, that particular asset class has delivered returns that have beaten inflation in their own currency over time. And if you go Google and you type hey Google, what asset class has beaten inflation over time, you're going to get the same answer year in, year out, right? So it gives us a bit of history to show that this asset class tends to do very, very well. Remember, what's the title of our presentation? The Rip Van Winkle portfolio. What can we invest in? That if we go to sleep, i.e. if we compound, we can make money. We don't want what we're going to invest in today and make money tomorrow. That's not compounding. Remember we talked about compounding is a secret sauce. But I didn't say it, Mr. Warren Buffett said it, lots of folks have said it. So compounding is the secret sauce. Let's look at this data piece again from my book. Let's talk about your money. Let's look at US market returns from 1928 till 2020. 1928. There was no Nigeria in 1928. 1928 to 2020. Let's look at the market returns. Well, compare the time frame. Look at the time frame there, 22 to 9 and all that, and we're comparing that time frame with stocks, bonds, cash, and inflation. So if you look at 28 to 1941, when America had the great financial crash, stocks did not beat inflation. So stocks were negative, inflation was also negative, right? Bonds were the king because that was when we had the market crash. So nobody wanted to take risk and everybody ran to bonds. From 42 to 68, stocks did 14%, inflation did 3%. 69 to 77, stocks did 2.9, inflation did 6.4. So stocks did not beat inflation. 78 to 99, stocks did 17%, inflation did 4.7. 2000, stocks did not beat inflation, were negative. 2009 till 2020, stocks have beaten inflation 14%, inflation 1.6%. Even if you go now, if you extrapolate even till today, stocks, US stocks have beaten inflation for the last 2 or 3 years when we had this disruption in terms of trade, inflation, and COVID. The point I'm trying to make is that this particular asset class over time seems to be either beating inflation or seems to be in line with inflation. You can't say the same for many countries or many indexes. You can't say the same. Which particular, if you just buy something, it allows you to beat inflation. It's very, very hard to find that, and inflation is the enemy. If there was no inflation, we wouldn't bother to save. We won't bother to invest, We'll just leave our money in our pillows and spend what we have saved. It's because of inflation that we invest. Because if you take $1 million and you don't invest it, it becomes 500,000 naira in 10 years. So you have to invest, to take on risk, to grow that 1 billion so it beats inflation. So guys are listening to me and saying, Kalu, I want to do what you are saying, right? But I don't have the skill, I don't have the time, I don't know what I'm doing. I'm just a quote-unquote lawyer or accountant or architect or whatever. I don't know what you're saying. Is there a simple way for me to do this thing you are saying that I can just take money, just do this thing and forget about it? I would not advise that. I would say try to understand what you're doing. But because you are asking, yes, there's a simple way to invest that you can capture the compound I'm talking about, capture the risk, and put it in a portfolio. I call it the Rip Van Winkle portfolio. Again, it's in my book, right? And if you look at what we've done here, there are 4 boxes there. Any investment you make is either going to be what we call a fixed return or variable return. Any investment. If you buy Bitcoin, it's variable. If you buy property, it's fixed. Any return you make is either going to be fixed or variable. Bonds are fixed because the returns, they'll tell you we're going to pay you 10% every year. That's fixed return. Equity is stocks are not fixed because they can't tell you what they're going to pay you. They will simply say they're going to pay you a dividend every year, but they can't tell you what they're going to pay you. So you only have 2 types of investment. One is fixed, one is variable. That's what we've done here. So in the fixed and variable, we've also created 2 columns. One for the US, one minus the UX. So see what we've done here. We're telling you that there are only 4 investments you can make on earth, and you've covered every investment class on earth. Just 4. 1, under variable income, equity, VTI. VTI, V just means Vanguard. Vanguard is one of the largest brokerage houses in the world. So when you see me using Vanguard, it's because they have the cheap expense ratio. You are going to buy the exact same stocks in other index funds, but Vanguard is cheap. So if you are going to buy the exact same thing, why go buy it anywhere where it's more expensive? That's why we're using Vanguard. They're not paying us. So it's Vanguard VTI. That's US stocks, about 4,500 of the best US stocks. So you see that VXUS is Vanguard International Stocks minus the US. So you've got 2 choices there for equities. VTI, VXUS. So either you're buying the US or you're not buying the US. Simple. But it's under variable. Then you come to bonds. It's either you're buying the BND, which is US issued fixed income, or you are not buying US issued fixed income, which is going to be BNDX. 4 options for you. So if you're a younger person, there's this rule with investing. If you are younger, you take 100 and you minus your age from 100. The larger number you get is what they want you to put in variable. So if I'm 30 years old, 100 less 30 is 70%. So 70% is what they want you to put more on the variable income. So I take my variable income, I have 70%, I can do 60 US, I can do 10 international. Mr. Warren Buffett said do 90-10. You can do 70, you can do 80, it's giving you an anchor. I can come to bonds and say, okay, US is very, very safe. I'll do, out of my 10% bonds, I'll do 20% US bonds, I'll do 10% international bonds. End of story. Well, end of story. You have captured your variable, you have captured your fixed. There is no other investment that is not captured in these 4 boxes. If Tesla issued shares, VTI will buy it. If a new company comes in Taiwan that is issuing chips, VXUS will buy it. You don't have to buy anything. If they pay dividends, VXUS will collect your dividends and give it to you. You don't have to do anything. That's why it's called the Rip Van Winkle portfolio. You can set this portfolio up and go to sleep. Just tell them reinvest my dividends. That's it. You don't check the market. You don't have to do anything. Just buy the stocks and go to sleep. You can say, okay, VXUS is I'm going to buy my Nigerian allocation in VXUS, because that's the international portfolio minus VTI. Very, very simple. It's not hard to do, guys. Very, very simple. But what must you do? You have to start early, so you compound, you buy into an equity fund. That's the trick. Start early, so you compound, you buy into an equity fund, because the equity funds we've shown you over time averagely is beating inflation. It's a very, very simple concept to grab, guys. And once you grab it, it doesn't leave you alone. It doesn't leave you. What is this? So this one, we can skip this for now. Let's not dwell too much. This is just the VTI, VOO. VOO is just talking about 500 stocks, while VTI is talking about 4,500 stocks. So if you want to be more concentrated, you do VOO. If you want to be broader, you do VTI. Yeah. So again, it's always asking, but Kalu, what is this VTI? Let's talk about VOO. Who are the stocks that are in this VTI VOO? I think I'll give you an explanation already. If you buy the VTI or the VOO, you are buying the top stocks by market cap, by returns that are listed. So let's look at what makes up VOO. VOO is just the top 500. This is what Mr. Warren Buffett was asking you to buy. He said put 10% in cash, i.e. US bonds, do 90% in an S&P index fund. This is what he was talking about. So VOO is mirroring the Standard & Poor's 500 index. So that's VOO. What's in VOO? If I buy one VOO share, I'm buying Nvidia, I'm buying Apple, I'm buying Microsoft, I'm buying Amazon, I'm buying Alphabet, that's Google, I'm buying Broadcom, I'm buying Facebook, I'm buying Tesla, and I'm also buying Mr. Warren Buffett's company by just buying this one stock, or this one ETF. Yes, I see your question. Can I buy this in Nigeria? Yes, you can. Go to your SEC approved app, search for VOO. If you don't have VOO, search for VTI. You might not, if you are trading from the UK, they don't call it VOO and VTI. They will call it something else, but it's the same thing. Look for what is mirroring the S&P 500. That's what you're looking for. What is mirroring the S&P 500? They might not call it VOO or VTI after America. Same in Nigeria, you look for VOO and VTI, it will pop up. Yeah, so again, this is not that hard, guys, right? I hear you guys. I can hear you guys. This is not that hard. All I have to do, get my age, subtract from 100, that larger number, I'm buying in equities. I start early, I compound, I buy equity funds because I go to beat inflation, and I reinvest the dividends. That's the secret sauce, guys. That's what Warren Buffett has done. All these guys you see in Nigeria, Mr. Tony Elumelu, Mr. Rabiu, they all have equity portfolios, guys. They all have equity portfolios. My good friend Lumide, he's always posting. Dangote has made some money from equities. Elumelu has made some money from equities. He's always posting that. That's what they are doing. If Tony Elumelu is buying shares, why are you not buying shares? And how old is Mr. Tony Elumelu? But you can make a higher ROI than Mr. Tony Elumelu if you start early. If you leave it late, then you lose your advantage to catch up with him. We're almost done, guys. We're going to have questions. We're almost done. Let's now come to the apps. Someone is asking, what apps can I use? My answer is use any SEC approved app. If you are outside Nigeria, the picture is there. There are lots of apps you can use. I use Robinhood. I use Betterment. I use Fidelity. I'm not advertising. It's just what I use. All these guys, and Vanguard, of course, all these guys are there for you. If you work for a company, your company would, if you have a 401k in America, they use maybe one of these guys. Just go to that same company and open up your individual IRA or stockbroking account. It's easier for you. You already have your information there, right? It's easy for you. If you don't have them, just go online and download the app. These are all apps. There are many apps here. There's one I saw that is for kids. So kids do a chore. You pay the kids for the chore. And as a parent, when you pay the kids for the chore, I think it's called Greenfield. You can take extra money and invest for the child. So let's say you tell the child, if you clean the garden, I'll pay you $5. When you pay the child $5, you can also invest $5 in the stocks for the kid. Sorry. So lots of ways to invest. Don't wait. The point is don't wait. Don't wait till you have 1 million naira, because when you wait, you are losing your compounding. So somebody is asking, what about Nigerian apps? I got you. This is Nigerian. So for Nigeria, we've gone to the SEC site and we've looked at the registered SEC apps. So I want to only use or recommend SEC approved investments, just for obvious reasons, right? So I went to SEC site. You have your digital stockbrokers. First of all, any broker that is SEC registered, you can use them. This is just the digital guys, the ones you have on your phone. Just the ones that are going to be on your phone. So you have Chaka, you have Bamboo, you have Trigger, Magna Cap. But the picture is there. Robo Advisors, you have Wahid Limited, crowdfunding, prop crowding, they've been on our space before, they are there. The digital investment fund portfolio manager, look at Cowrywise is there. So all these apps, I'm pretty sure, Cowrywise, Cowry, Bamboo, they would have all this VOO, VTI, all that, they would have it on those apps. If they don't have it, ask them to get it, because it's not that hard for them to get for you, right? So if they don't have it, ask them that you want it. That one guy on Twitter told you to get it. And you want them to get VOO for you so you can invest in VOO. They'll get it for you. Right? So that's the shade on that. Just to make this point, right? There are many things you can do in the ETF. It's not that clear, so I'll leave this alone for now. There are many things you can do, right? Let me just talk on the Nigerian ETF mutual fund market just slightly, just because we're in Nigeria, just so you guys have a sense of what I found out, right? I tried to do my research. I told this, what funds do we have out there that have 100 billion? There is none. 50 billion? There is none. This is a growing market in Nigeria. What market? This mutual fund equity market that has just equities. It's a growing market. Not a lot of firms have this. But I did find some that were there that have assets under management more than 10 billion. Yeah? And I listed them. There are many of them. I listed just a few. There's Stanbic, There's Chapel Hill. Chapel Hill has the Paramount Equity Fund. Stanbic IBTC has the Nigerian Equity Fund. ARM has the Aggressive Growth Fund. These are all equity funds. As you can see, that they have to do a 70% minimum of their funds investment to equity. So minimum they have to do is 70% to equities. The expense ratio, I put them there for you. Again, they are buying almost the same thing. So the expense ratio are there. There's 3.0 to 2.2. So you have to choose which one you want to buy. Because they are buying the same thing, I prefer you go for the cheapest. But again, it's not much difference between 3 and 2. But hey, the benchmark there is the NGX All Share and the NGX 30. So again, when you are buying, I didn't see a pure play index fund in Nigeria for equities. What that means that I didn't see any fund that just mirrors the index 100%. I saw you see NGX 30, they take the 30 best stocks and they mirror that. Then the All Share Index, that's the IBTC, is also doing that as well. I think only with the Vertiva ETF was in there, so I saw that mirrored the stock market 100%, right? But that's an ETF. And like I said, ETFs in Nigeria don't have a lot of liquidity. These guys, mutual funds, have more liquidity than the index funds, than the ETFs in Nigeria. But it's also to give you an idea of what's out there. So while you're searching for the US apps, if you want to Nigerian ETFs, these are your guys to go to. There are lots of stockbroking firms also have their own funds. There's Meristem, there's AfriInvest. They have their own funds, but most of those funds are specialized, i.e., there's a banking or a dividend and all that. I want you guys to start from the top, then work your way down. So again, it's not exhaustive, but just the ones that I found that are a bit large, right? So let's come back to our answer. I know I asked you guys earlier that who do you think won that competition between Mr. Warren Buffett and the guys that said that the hedge fund guys that said they could invest, trade. So in effect, this is the bet against being passive and the bet against being active. Index funds are what we call passive. You buy them, you invest them, you go to sleep. Hedge funds are traders. They are buying this, they are hedging this, they are doing that to make a profit, like Mr. Gordon Gekko. Who won the bet? Mr. Warren Buffett won the bet. What does that mean? That means if you guys listening today take money, buy an index fund that is going to invest in equities, US equities, Nigerian equities, and you leave that fund alone, you go to sleep for 10 years, you are going to make more money than the guy that is doing buy, sell, buy, sell, buy, sell. Why? Fees. When you buy and sell, you are paying fees. Fees disrupt your compounding. But if you just buy and leave it there, it's just compounding. Your £1 becomes 1.1, because that 1.1 interest becomes 1.2, like that for 10 years. So we've done that experiment, and Mr. Warren Buffett won. What it means is this: if you start early, you start to compound, you reinvest your dividends, you will make a higher return on investment than someone that starts later and is having to trade to catch up with you. Because you know this, you have no reason not to start early. Boys and girls listening to me, you have no reason not to start early. So, see, I'm nearly retired, right, myself. And when I started to invest, the first stock I bought in my life was First Bank. It wasn't called First Bank, it was called Standard Bank. Standard Bank was leaving Nigeria, and they were selling their shares to Nigerians. That was the first stock I bought in my life, Standard Bank shares. And I didn't know a thing about buying stocks. I thought, because I just watched Wall Street and see Mr. Gordon Gekko buying and selling stocks. So my mind was that I was going to go and buy, because I saw 50 kobo, that was when I sold the stock, 50 kobo. But I saw 325 naira. So I thought you could buy the stock for 50 kobo and I could sell it for 325. That's what I thought. So I went to Broad Street in Lagos, or Marriott, that was a big First Bank office, and I told her to buy shares. I wasn't in university then. Lady looked at me and said, "How much do you have?" I said, "I have 500 naira. Because I went to the village and one rich man gave me 500 naira. It was a lot of money. It was like having, I was having 50K, something like that. Then he says, well, you have to go to the stockbroker. I didn't know what the stockbroker was. The lady talked to me so nice. It was that lady that made me actually continue my stockbroker. She explained it to me, said, go to Daily Trust building. The stockbrokers are there. That's where I went to, and I met one guy out to buy stocks. The guy took me, and I bought First Bank shares. There was no online trading. There was no internet. There was no telephone in Nigeria. When I bought those stocks, I had to go back the next week. They'll print you out a contract note. You will sign that contract note, then you get a certificate, paper certificate. If you want to sell, you take that paper certificate back to the stockbroker. They sell for you. It takes maybe like 2 or 3 months. There was no online to go and research. There's no grok to ask PE. Nothing. It's just what you know and what your broker tells you. You understand what I'm saying? Today, if you're a 25-year-old guy in university, on your phone, on your mobile phone, you can buy Tesla from Aba in Naira. There is no excuse. All these people are doing trading crypto. That's not trading. You can't trade with less than $100,000. You're wasting your time. Sorry if I've been coming out being cold. Take that money, invest it. You look like a quote-unquote fool today. Leave it alone. Just take that money, buy index fund, leave it alone. Focus on your schooling. When you leave schooling, look back at that portfolio. You'll be shocked what you have. I'm giving you by experience, not theory. When I got married, I sold my portfolio in First Bank. That's how I paid for the entire wedding. I tried to calculate the returns I had made on First Bank. I couldn't do it. So it couldn't fit the computer. I'm not giving you theory. From the public offer I bought, the bonuses, the shares that they gave me, I couldn't calculate the return on the account. It was too much. It was like 6-figure percent return. I didn't sell it. I reinvested all the dividends, the bonus shares, everything I got. When I sold it, I was able to pay for my wedding. Posh wedding, VI, tent, near the water. So, be very strategic if you're a yoga. The market is not there for you. There is nothing that a kid in New York can do. You can't do. There is no excuse anymore. You have the phone, you have the apps. There are Nigerian apps that will take Naira from you and invest for you. So you have no excuse. Stop doing betting. Stop doing crypto. You don't have the means to trade in crypto. It's too expensive. You can't really make money from that. But with stocks, you can buy stocks. You can open an index for Nigeria with 5,000 Naira. Most ETFs will start with $25. Do that. Then focus on your schooling, right? Do that and focus on your schooling. Alright guys, I'm going to stop here because I know lots of guys want to speak. I hope I have communicated some less learnings to you guys, right? About investing. This is not a hard thing to do. Investing is all about time. It's not about trade, it's about time. The two T's. If you trade, you are taking risk. But like Mr. Warren Buffett has showed us, right? If you simply start early, invest in equities, reinvest your dividends, you can make a lot of money. You can beat the experts in the field. That's what I want you guys to do, right? So let's go right now into questions, right? And then we'll just take a few. If you want to ask a question, ask on the DM and also ask on the space. I'll take, like I said, I've got time and I'll take every question. Let's start from Pro Sage. Pro Sage, how you doing? Welcome to the space.
Good evening, Mr. Kazu. Thank you for everything you do for us. I had a question earlier, but you had already answered it. I wanted to ask a question on AfriVest equity-based mutual fund, but you already cleared my doubt, so no question. Thank you.
Okay, fantastic. Yeah, so every stockbroker, what I posted here is the apps. But if you go to, say, AfriInvest, you go to Otto Stevens, you go to Meristem, you go to any trader, they have their own stockbroking website. So you can easily just get those ones there and invest. These are the apps itself. That's what I'm posting, just the apps itself, right? Jay Olayinka, how are you doing, sir? Jay Olayinka, can you speak? If you can't speak, let's go to Ifrex Trading. Ifrex, how are you doing?
Hello, good evening, Mr. Carlo. I am fine. How about you?
I'm doing very well, sir. Thanks for being here today. What's your question?
Yeah, it's been a pleasure. My question is like this. You've mentioned how you started in the early days when we did not have even internet connection or phone in Nigeria. And I want to see, did you solely invest in Nigerian stock? Because I heard you say that was what paid for your wedding then. So, or you were doing mixtures of Nigeria and the diaspora stocks like outside Nigeria, or it was basically Nigerian stock?
Yeah. So back then you could not buy foreign stocks. You couldn't. It wasn't possible to buy foreign stock because remember that, right? Even today, you need a social security number to buy a foreign stock. So what the American company is called? This company called, their name escapes me. What they've done is that they've allowed the Nigerian apps to open accounts in Nigeria. But then when you place your order, it goes to that broker in America. That broker in America executes for you. That's why you can do it today. You still need a social to have an account in America, but that app is like a midway for you. So when you go to say Cowrywise and you buy Tesla, they are placing the order on behalf of that company in America, that stockbroker in America. So back then it wasn't possible to buy foreign stocks. I bought only Nigerian stocks, not because I couldn't, but there was no way you could buy foreign stocks. I bought First Bank. I think I bought Nestle. A few of them, but that was really First Bank. And I did, like I said, I bought this stock before I got into university. So it's the money I got from when you go for Christmas and they spray you money. So they sprayed my dad money and I picked the money from the ground. And my friend's dad also gave me money and I had 500 naira. That's what I invested. So an early start, it's not theory. I've given you my own experience. So yeah, I want you to copy what I've done, because if I knew what I know now back then, I wouldn't have bought a car in Nigeria. I would have taken the money for the car and bought more Nestle, taken the money for my phone and bought more First Bank, and now maybe I can afford the Range Rover today. So it's very difficult to tell young people not to spend money, because they want to show off. And I get it. I'm not calling you out. When you are younger, you have that inclination. But if you understand how wealth is created, that whatever you invest today, you will make more money tomorrow. It helps you. My dad had a saying, it's in Igbo. It's Konk Igbo. So I'm not even going to try to repeat it. It might break Twitter. Let me even try. Nganga yakbaichi ikpaya tare nehi yakbaichi. Sorry. What he was trying to say was this: if you show off today, what will you show off tomorrow? So again, I want to talk to the young people in Nigeria today. You've got to be very, very deliberate about how you invest money. You can't waste your time, and I'm using this word very seriously. You can't waste your time gambling and crypto. Crypto is not bad. The problem with crypto is that you don't have money. You can't take 10,000 naira and buy crypto. What would you make? But if you take that 10,000 and you buy a stock today, because that stock is compounding, you are going to make more. I hope that answers you, Ifre.
Yeah. You have done a lot. And if this is like this, and how come the people that have been investing like early 2006, 2005, I often heard them complaining about Nigerian stocks. You hear a lot of people say they lost money to Sobank stocks.
If they lost money, that tells you they were trading. So, I used to see these apps. I used to see this comment. Somebody posted, I think a long time ago, his father got a bank share and he went to the stock market after 20 years and he got his father's shares. And when he sold the shares, he calculated that his father had made only 20,000 naira. And it was trending on Twitter, and I replied to the guy, your calculation is wrong. When you buy a share for 10 naira and you get a dividend and a bonus, your price goes down to 9 naira or 9 whatever. It keeps on going down. At a point in time, the dividends and the bonus have paid back your total principal. That's why I couldn't calculate my return on the First Bank, because my First Bank shares were now worth 0, i.e. the cost of buying those shares was 0. So whatever profit I got was excess profit. I used 500 naira to buy shares of Standard Bank at 325 kobo. But over the years, First Bank gave me dividends and bonus that paid me back that 500 naira many times over. So when you look at the cost, they look at the cost. They don't do their average costing down. So they say, oh, we've lost money because they are trading. If you buy and you hold as a young person, it's difficult, especially you buy an index. If you go and buy Onwuka High Tech, there's no index. So because there's no index, the manager can't sell Onwuka High Tech. If we had an index fund in Nigeria, the manager will sell Onwuka High Tech and buy Flutterwave. You see what I'm saying? The manager is managing the index fund. But if there's no index fund and you buy yourself, then you get stuck. All right, let's get Bataki.
Hello, thank you. I have a couple of questions to ask.
Yeah, go for it.
Okay. I think around 2006, back, I think my dad only shared in Zenith Bank. Anyway, so that was where I had first experience about shares. But I don't know what happened at that time. He actually applied for a number of shares, but after some time they refunded back some of his money and they said they allocated some for him. So I didn't understand what actually happened, but they couldn't give him the number of shares he had applied for. And so he later had just a couple of shares with them, though they have been paying dividend, but have not been keeping track on it. Okay, until I think somewhere last year, I just started buying my own share. When the bank started selling those public offer, I bought from 2 banks. And one thing I want to get a light on, they paid me dividend. I think that was last year. I actually spent the money, but I would have reinvested it, but I don't. I'm just buying, like I just bought from the 2 banks, not through stockbroker, and they paid me dividends. One of the bank linked it to my account because I have an account with them, and they paid the dividends into the account direct. Then the other one, they asked me for CSC accounts, so I registered the stockbroker from Mary Trade, and I gave it to them, and they regularized it. They also paid me dividend to my account. So how would I have reinvested those dividends that I was paid back into the share? That's one question. And number 2,
hold up. Let me answer the first question. So that's a great question. How can you reinvest your dividends? There are many ways. So if you are buying shares abroad, they usually have what they call a DRIP, the Dividend Reinvestment Program. So if you buy shares abroad, like I'm sharing the apps now on YouTube, all the apps you guys abroad, ask them, do you have a DRIP? If they have, sign on for it so you can reinvest your dividends. Now, if you buy shares and there's no DRIP, what you simply want is to open up a savings account. When you get dividends, put in your savings account, and then you buy your shares, or you get the physical share, you take it to your broker, you can just give them the dividends right there and then. The broker can receive your dividends check and buy. In Nigeria now, they will actually open a bank account, right? So it goes to your bank account. Once that bank account should not be your normal bank account. Let that bank account be an account that is only for dividends. So the money goes to that bank account, you track it, and you issue a check immediately back to the stockbroker to buy you the same shares. When you buy the same shares, you are compounding. If you don't buy the same shares, you are compounding the portfolio, but not the share itself. But if you buy the equity fund, you are compounding. So that's how you do it, sir.
Okay, so I understand, but I think from what you're saying, because it's just my first experience, I didn't know much about it, so I actually linked my normal saving account to it. So most
That's
of
fine.
the dividends we are
No,
paid,
but you've linked. That's fine. What's the next question?
Okay, the next one is I have been buying shares from through Meritrade because I opened Meritrade and Bamboo. But that Bamboo, what I've been doing is just saving.
What's the question?
You said what?
What's the question?
Okay, yeah, the Meritrade, I've been buying some shares, like some Nigerian shares, like Boa, Dangote, and I'm just, like any excess money that is left in my hand, I'll just use it to buy. So I hope, like, those ones I'm buying is also like the same public offer that they do sell from that Bamboo, from the Meritrade app.
I don't understand the question you're asking.
Like I've been buying shares from
So
Meritrade.
hold up. If you are buying a share from a broker, it's not a public offer. It's no longer a public offer because you are buying from the market. The broker is a market guy. You only buy public offers from the company selling. So the company will tell you we are selling through Meristem. But if you are buying day to day from Meristem or through Bamboo, it's no longer a public offer. I don't know if I answered that question.
Yeah, you answered it. So, can you throw light on the difference between buying this public offer or buying? Is there a big difference between buying from public offer or buying direct from a broker?
Not really, but you only buy a public offer once. So when Dangote Cement sold his shares, he sold through public offer for the first time. After then, the money goes to Dangote. After then, you are now buying from brokers. So you are buying from myself or from somebody else on the market, not from Dangote anymore. Dangote will sell his shares to the public. You buy from Dangote, the shares go to the public. Following that, you then buy from the market, no longer from Dangote. So public offer is once, initial public offer is once, then after which you are the market participants are now playing to buy and sell shares. Great question. Let me get Kijo.
Okay, sorry.
Hold up. No. Let's get Kijo, yeah? Kijo, go ahead.
Hey, Carlo, how you doing today?
I'll do very well.
Great. I wanted to, first of all, talk about my stock in Nigeria. I got an IPO, Union Bank IPO in 2005.
Yeah.
For about 20.
Can you hear me, sir?
Man, you got to hold on. We have someone speaking. Kijo, go ahead.
Yeah. So I got the IPO in 2005 for about 20 naira for Union Bank, and now I can't even look at it any longer. But that's that. The main thing I wanted to find out from you is, which would you rather do? Buying, stocking up a lot of stocks here, or going for a life insurance? The reason why I'm asking about that is, if you decide to sell, we pay a whole lot of taxes on that, right? And from what I understand, I think I can save more if I'm doing a life insurance.
Mike, so no, you are totally okay. That's totally off. So look at it this way, right? Life insurance is not an invest. How to say it right way? Yeah. When I ask people to do a financial plan, life insurance is the second thing I ask them to do before they invest. But life insurance is not quote unquote an investment. It's a special kind of asset where you can put in 1 naira today and you get 1 million immediately. You use life insurance to protect a loss of income. So if I have a dependent, I buy life insurance because if I go away, my dependents get those funds to pay for the education or to cover the mortgage. But I cannot compare life insurance with investing in state bonds or stocks or property. No, they have different uses. My life insurance does not compound. I'm buying a fixed sum assured, maybe 5 million or whatever, it stays at that amount. My equities, my bonds, my property can compound. I can buy a property in Lagos and it goes up to 20 million in a year. Life insurance doesn't do that. But there are two different things. I use life insurance to protect income for my dependents. I can tie my life insurance to my trust to pay my dependents, pay education, pay my mortgage, but I can't really do that with stocks and shares. As to paying taxes, you have to sell at least 150 million or so to even pay tax on the capital gains when you do your buying and selling. But remember what I said, we're not talking of buying and selling. We're talking of buying, accumulating, and compounding for the next 10 years at least. So the buying and selling guys are the guys that Mr. Warren Buffett defeated. You see what I'm saying? Those are the guys he defeated. But he said, listen, if you are trading and you are buying, I can make more than you. And he proved it over a 10-year real life. I'm asking you to copy him. Copy him. Now, does it mean that tomorrow, if you get excess money, you can't trade? No, it means that have this portfolio, your long-term portfolio. If you now have loose money, open up a trading portfolio and start to trade. No problem. But start with this one. Start with this triangle, broad-based portfolio of your long-term savings. Then build from there. Does that make sense?
Yeah, I get that.
Excellent, fantastic. Let's get who was it? DeFi Scholar. DeFi, how you doing?
Yeah, I'm doing fine, sir. Good evening. Can you hear me?
Yes, I can hear you.
Okay, so the question I have is big. I'm coming into stocks trading, so I wanted to know if I go to Bamboo and I open an account and I buy something like VOVIT, how is the reinvesting going to work, like the dividend? If I have to perform any action, or is there any specific thing I'm supposed to do? Thank you.
That's a great question. So ask them about that. Ask them, how do I reinvest? If I get a dividend, will they pay me in dollars? Will they pay me in naira? Ask them. Whatever they answer, that'll be your next point, right? If they say that, they're going to pay to your bank account. Okay, tell them, can I just do it automatically back to buy more VO? If they say no, then do what I said. Get dividends, put in an account, end of the quarter, write a new check, and give them to buy more. So it depends on how they are set up. The ones I use that are offshore, I just stay drip. I've never gotten a dividend check ever. If they pay dividends, I always reinvest it, because if I get dividends, I go and buy. I'm very, very bad with. I'll just go and buy rice or something. So I leave it there. So the same way with you, if you can have a dividend reinvestment, do that. If they don't have it, then do it the manual way. Receive dividends and then invest on them. So ask them. If you can ask them now, let me know and I'll tell you what to do. But ask them how they operate it. So if you guys know Bamboo, Rise, Cowrie, how do they pay dividends? If you can send me a DM or a WhatsApp tweet, I can look at it and I can advise you. I haven't looked at my notifications. I'm going to look at it right now. So if you guys know how, tell me, then I can advise you. Yeah? Okay. Did I answer your question on DeFi?
Yes, sir. Just a little one. You mentioned something about dividend during the tax time. That dividends are not. I'm not going to quote unquote you, but I think you said dividends are not going to be.
You're right. I said that if you buy a collective investment scheme, the dividends returned to you are not taxable. They are tax exempt. So if you buy a mutual fund, an ETF, a money market fund, and they pay you a dividend from that fund, you will not pay a tax on that they pay to you. That's what I said here. So I think he dropped up. That's what I said. So let me just read YouTube questions, right? Could you point me in the right direction regarding strategies for building wealth for a child? I'm not looking for specific advice, just general guidelines. Chidibem, the first thing I'll say is this, right? In my book, I have a title called Specific for Building Wealth for Children, how you can set it up. But the easiest way to do this is this. If you live in America, try to open an IRA for your child. An IRA means an individual retirement account. So you say, my child is a baby, doesn't matter. You can only pay earned income to your child. You can't give your child money and put in the IRA, only earned income. So what is earned income? The child has to have a job. Oh, can my baby have a job? Of course your baby can have a job. Your baby can have a job as a model. So if you have a business, you take a picture of your baby, that baby is the model for your business. You pay the baby a paycheck, literal, you do a contract between your baby and your company. You pay the baby the contract fees for being a model. You take that check, you put in the IRA, ROTH, ROTH, IRA for the baby. That's a complicated one. Even if you can't do this, there are many other apps that allow you, like there's Acorns. With Acorns, you can invest for the baby and you can buy shares immediately for the baby, legally, in the baby's name, in the baby's social security number. But let's say you don't live in America, you want to do that in Nigeria. Go to your stockbroker and say, I want to open up a custodial account or an account for my child, and I want to invest shares in the name of the child or the name of the child. If they don't agree, open up a trustee account and buy shares in the baby's name, in the name of the trustee, to be given to the baby or to the child when they reach a certain age. There are many ways to do this. Just ask your banker or your broker or your lawyer. They'll show you how you can build wealth. The best way to build wealth for a young person is to buy equities for that young person. I'm talking about a 14-year-old guy. I think I shared this slide with you guys where I said if you wait, you lose money. If you snooze in investing, you lose. If you snooze in investing, you lose. And I give you guys the numbers. The numbers are there. If you have the same 200 naira and you invest when you are age 20, you make 209,000. The same time, if you wait till you are 35, you make only 82,000. So you only make 34% if you wait for 50 years. So that's how you answer that, Chidubem. Ozioba, how can one invest through Vanguard? Vanguard is a company. So Vanguard sells ETFs and mutual funds. There are many companies that also offer. Vanguard is like a stockbroker, right? It's like IBTC, it's like many stuff like Africa. So you look for that company that has very, very cheap expense ratio. Then you buy your ETFs or mutual funds through there. The issue is the same thing they are selling to you. So use the cheaper one to buy it. Okay, how can we start? Are these on an app? Yes, they are all on an app. I've shared you the apps. So start tomorrow. Go to your broker, go to your banker and ask them to start. Yeah? Is there a website register? Yes, go there and start. You just start. You can find this out. Just ask Google or Grok, how can I buy equity index funds in Nigeria? To tell you. Can I invest in a US ETF in Nigeria without having a US account? Yes. You can use those apps we just mentioned, Cowrywise, Bamboo, Shaka. You can open an account in Nigeria to invest in a US ETF. That's what we just explained to you. Yes, you can. How do I manage fees for those apps? You can't manage the fees. It's what they ask you to pay that you're going to pay, unless you have a better way of doing it. If your child has a social security number, you can go direct to America and open an account. It's cheaper. But if you don't have a social security number, then you have to buy through the apps. Let's get to Yogi Berra. Yogi Berra, how you doing? Yogi Berra. I can't hear you, so if you're speaking, I can't hear you. Let's get Black Child. How you doing? Black Child, go ahead. Black Child.
Good evening, sir.
How you doing?
I'm fine. Thank you for the lessons. I just have a quick question. Between dividends paying stock and non-dividend paying stock,
yeah,
and how they can impact on our portfolio.
Yeah, good question. I think it's a great question. So let me put it this way, right? I personally do not like stocks that don't pay dividends. But the way Americans think is this. Americans will say, why should we give you a dividend when we have a better use for the money? So Tesla does not pay dividend because Tesla will tell you that they have a better use for that money than giving it to you. They can make cars cheaper, which causes cost of cars to go down, which makes you the investor more money. Microsoft didn't pay dividends for a very, very long time. So all these tech companies don't pay dividends. As a matter of fact, paying a dividend is looked at as if you are now a mature company, which means you are no longer growing. Because you're no longer growing, you're now looking for ways to use that money. That's their thinking. But I personally like dividends. But I did see a chart once where they compared dividend-paid ETFs to non-dividend-paid ETFs. And dividend-paid ETFs or stocks in that ETF had a higher return on investment than non-paying dividend ETF. So I look at dividends to me as my insurance policy. If I buy a stock and the share price falls, at least I got a dividend. Rabi, at least I got a dividend. Because the share price is, quote unquote, doesn't mean much. It just means how much the market wants to sell to you. But if I get a dividend, that's real money, cash money to me. I can use that money, I can reinvest, or I can even retire with that money. Remember, the whole goal of investing is to build your passive income. The reason why we're doing what we're doing today is we want to build passive income. There is no point having an investment that does not pay you passive income. What's the point of having shares of a company in America where you have tied your money down, but you're not getting the dividend back in dollars? What's the point? People say future growth. I get it. But again, the whole idea of investing is passive income. Mr. Warren Buffett only buys companies. He can take their cash from those companies and buy new companies. So you're looking for that cash return when you invest. Hope that answers your question, sir.
Yeah, thank you, sir.
Fantastic. Let's get Yogi Berra here to speak. Yogi Berra? Okay, Yogi Berra is off completely. Let's get Mr. G. Mr. G, how you doing? Mr. G? Okay, let's get Ebuka. Ebuka, hi.
Yeah. Hello.
Yeah, Ebuka, I can hear you. Yeah, I can hear you.
All right. I have a couple of questions to ask.
Okay. Go ahead.
First of all, how do I analyze a stock to know if it's overly priced?
Ooh.
Sometimes I see some of these stocks and then I want to invest in them, either the blue chip or growth stocks, but I don't really know if they're overly priced. Especially now with the Nigerian stock, everything seems like premium. I don't know if it's overly priced at the moment.
Do you know the difference between price and value?
No.
Okay, let me give you an example, right? If you go and buy beads, why you buy beads? Why? Why you buy beads? Tell me. It's not a trick question. Not a trick question. Why do you buy beads?
To eat, basically.
Because of the protein, because of the carbs, right?
Yeah.
Okay.
Yes.
Will that ever change? Will that change?
No, it won't.
It will never change, Abby. Okay. What about the price of beans? Does the price of beans go up or down? Does it change?
Yes.
Okay.
It does.
So the value of beans is the same. It stays constant, Abi?
Yes, it does.
But the price of beans goes up and down, Abi?
Yes.
So your question to me is, you're asking me, when can I know that beans is overpriced or underpriced, Abi? That's your question. So the way you know this is, you have to calculate the value, what we call the intrinsic value of beans. When I asked you, why do you buy beans? You said to eat, because it's giving you protein and carbohydrates. What's the value of protein and carbohydrates to you? If the value to you is 1,000 naira, so let's say you have done your calculation of the intrinsic value of beans, and the value of beans came back to you at 1,000 naira. So question for you, right? Ebuka, value of beans is 1,000. If I sell you beans at 900 naira, will you buy? Value of beans is 1,000. I'm offering you beans at 900. Would you buy? Ebuka has fallen off. You will buy because the price of beans is below the intrinsic value of beans. So it's underpriced. So as a trader, you want to calculate the intrinsic value of beans. Once you get that number, you then want to put a price target and say, once this price falls below the intrinsic value, I buy. Same way, if it goes above the intrinsic value to a percentage that I have predetermined, I sell. So to answer your question, you have to know the intrinsic value of that stock that you want to buy or sell. What makes that stock make money? What is the value of that unique selling point? If you get a number to it, then you buy and sell based on the intrinsic value. But again, if you want to look at it this way, if the volume is dropping, the value is dropping. I'll stop there. Anila, where's Anila? Anila has dropped off. Mr. G, are you ready to speak now? Mr. G, I've called you twice. I'm going to take you off. King, KVNG. KVNG. Where can I buy the book? If you want to buy my book, it's only on Amazon for now. I do apologize. It's only going to be on Amazon for now. We no longer have it running in Nigeria. We did three rolls all sold out, but just on Amazon for now. Yep. Go ahead, sir.
Can you hear me?
I can hear you. Yeah.
So I have two questions to ask. First question, I've been trading the Nigerian Stock Exchange for like I'll say 3 years now. I traded that money, so I use my return capital gains to buy landed property. The second question, why is it that whenever I think that I'm into the stock market, it sounds as if I'm wasting my time?
I don't get the question. Help. So you buy stocks and then you take the profit and you buy landed property. But what's your question? I didn't get this question. It was saying something about wasting his time. I didn't get that question. Really good. Okay. KVNG, go ahead. So on YouTube, Obina is asking, how do I manage fees in these apps? Like I said, those fees are a bit high, but remember you are buying in Naira to buy a US fee, to buy a US stock. I think those fees are charging you because of that. There's really nothing you can do, really. If you want to get exposure to the US market, you've got to pay for that exposure. I think it will come down going forward, but for now, there's really nothing you can do, right? There's nothing you can do about those fees. They're going to charge you to get access to the market. Yeah. So you guys are having difficulties joining up. Let me go to DMs and read a few DMs there. I want to ask if all mutual funds pay dividends like VO. No, the DeFi, you want to make sure you find out if they pay. They will tell you if they pay. There's a particular ETF called VYMI that is solely for dividend. So if you buy a growth mutual fund that is just investing in IT, sometimes they don't pay dividend because they are focusing on growth, not value, right? So make sure you look at the prospectus. They will tell you when they pay dividends last. So if you're a dividend guy, make sure you read the prospectus. But VOO, VTI, VT, all those big ones all pay you a dividend. That is correct. Who hasn't spoken? I've got Mr. G and Bataki. You had a question. I think I caught you. I didn't get to speak. So, what was your question, sir? Pataki, you've got the floor now. Do I have an email address you want to write to? Yes, my first and last name at Gmail. Just right there. Yeah, so, 10 years ago, was it 10 years ago? I think it was 5 years ago, on this same space on Twitter, I think I formed a Telegram group and I told some guys to go out and buy VTI. The Telegram group is called Invest 2030. Yeah? And they've all bought VTI. So yesterday I asked them, at what price did you guys buy VTI? I know the price they bought, but I want them to see their profit that they have made on just buying VTI and holding. So this thing is not a hard concept to get, guys. Like I said, I'm giving you... Yeah. So when we bought it in 2022, that's when we started the Telegram group, 2022, VTI was $167. $167. Today, VTI is about $240. So all the guys that basically did what I'm telling you to do now made 100% return on their principal in dollars. 100% return. It's not magic, and it's nothing new. You buy an asset that's going to go up in price, and you just leave it alone. You don't trade it, just leave it alone. If it's a good asset, why are you selling it? So 5 years ago, they bought VTI, they made 100%. I'm telling you guys to do the exact same thing. Will the stock market fall? Yes, the market will fall. Stocks go up, stocks come down. But what is the trend? Look at the trend. What is the trend? The trend is always your friend. Tomorrow, the entire market might crash to zero. But don't sell. Buy more. Average your cost and stay there. Because if the whole market crashes, then the whole economy has crashed, and the market will still recover, right? So I've got to answer that question for you. How can I get your book? If I answer that question, Telegram stock, you are extremely green. If you are green, you've got to do a lot of reading. The sound is going, oh my God. I'm so sorry, guys. I think the sound went off on Twitter, so I had you two guys are hearing me. So, like I was saying on I'm so sorry about that, guys. I think the sound went off. Yeah, Twitter might kick us off very soon. I think Twitter might kick us off very soon. It's looking dicey, looking very, very dicey. I'm so sorry, guys. Yeah. So again, like I said, 5 years ago in 2020, we had on Twitter had a challenge where we asked folks to go out and buy VTI. The same thing I said here. I told the younger folks that listen to me, go and buy VTI. Why? Because the US market, you are younger, put your money in VTI. We actually created a Telegram group called Invest 2030. So I asked them yesterday, as at half year, our target is 10 years. We're 5 years in, they've made 100% on their investment in VTI. So VTI, VOO, almost the same thing. VOO is just 500, VTI is about 4,500. They invested about when they bought 2020, it was about $167 per stock, per ETF unit. Now it's about 340, nearly 100% return. So these things are not, it's not magic. It's just reinvesting and compounding. That's apparently how you make the funds, right? So go in there, guys. Don't wait. Don't wait for I'm not making money. The minimum is for stocks in Nigeria is 5,000 naira to open an ETF account or a mutual fund account or a CSC account. Open up a CSCS. That pocket money you get, buy stocks, forget about it. Leave this trading alone. Leave this gambling thing. Leave it alone. It will ruin you. Crypto, you don't make enough money to trade crypto. But this is an okay one for you. You can buy equities, you can have it, you can hold it. After 10 years, you will not lose money. It's difficult for you to lose money in an index fund. Very, very difficult. Unless the entire economy becomes Sudan or Somalia, where everything is gone, then you really go lose that money. Anila, how you doing? Anila, please go ahead, Anila. Anila? Hope you can hear me, Mr. Anila. Please go ahead with your question. Yeah, go ahead.
Yes, I can hear you, sir. Good evening.
Okay, how you doing, sir?
Yeah, I'm good. Yeah. So, Carlos, first and foremost, thank you for this, because I started listening to this investment program like a year ago first. And I've keyed to most of those things that you have been teaching, right? I want to appreciate you. First and foremost, I really appreciate it.
Thank you, sir.
Because I'm just a little bit years ago. But with your lesson and with AI, I was able to set out and confirm most of those teachings on YouTube. So now I want to divert to the US stock. I would have been doing some Nigerian stock. I buy, I resell some, just to learn. I think I told you, if you can remember, I was the guy you referred this one. Awapa listening to the other time.
Yeah.
Where I was talking about RSA.
Yeah.
I don't know if you remember me.
Yes,
so
I remember.
I tried to just switch to equity market investment instead of RSA and insurance, like we discussed that time. So I've actually learned more about it now. But I'm trying to key into US market, right? So this VTI that you mentioned, and the S&P 500 that you mentioned, I've read about that too. But then again, I was thinking about, because I don't have large capital to start on that axis. So I'm thinking that, what about if, how can someone get the list of all the new companies that are just getting listed on stock exchange in the US, where someone can just be buying individual stock? Will you advise that? Or you strictly advise just this VTI, VO, and S&P 500? Things I just want to know. Because I want to start using Bamboo for the foreign stock. I was seeing IEZ for the Nigerian stock. So I don't know if Bamboo will be having those new listed stocks that still have low amounts, whereby, yes, I have like 100,000. I can use to purchase a good amount of units of stock on those newly listed stock in US.
So look at
what we advise.
Yeah, look at it this way, right? So look at the point I'm making. What's an index fund? An index fund is you go to the market today. You want to buy things. You don't have enough money. There's rice, there's yam, there's oil, there's chicken, there's turkey, there's pepper, there's Maggi. You don't have money to buy all those things. So what do? You say, okay, I'm going to have a basket. Give me 5 naira rice. Give me 5 naira turkey. Give me 5 naira oil. You buy 5 naira into that basket. Then you take that basket home, and you do jollof rice. You don't buy a bag of rice. You don't buy a tin of oil. You're just buying small into that bag of rice. Once you buy that bag of rice, you take it home. Sorry, do that basket. You go and you do your jollof rice. That's what index fund is. When you buy the index fund, you have automatically bought all those stocks. When you see Mr. Warren Buffett says buy S&P 500, that means you are buying the top 500 stocks in America by just buying that one index fund. You see? That's the point. If you try to buy those stocks by yourself, you don't have the money. So number one is cheaper. Number two is diversification. You remember I shared with you the constituents of the index fund. It's all those big stocks, the Teslas, the Alphabet, the Googles, the Amazon, they're all there. So you buy with $1, you are getting access to 500 companies. So do that first. Understand the market first. Then tomorrow, you can then say, I now know more about the market. I can go and buy individual stocks. You follow what I'm saying? Start off with the index first. Then do the individual. Because that's what Mr. Warren Buffett, the richest guy, the guy we all respect in investing, that's what he has asked us to do. Not because we should follow him blindly, but he has shown us that if you do it that way, you beat trading. That's what he's saying. So do it that way. Then if you then have more money, you can have a trading account, you can have your own other account, but do it this way to start with. It will help you. Yeah? Make sense? Okay, Ayla. Another question. Let's get Cosmas. COSMAS. Building a brand in finance market that helps individuals understand the retailer's psychology and how to navigate. Cosmas, you've got the floor. Please go ahead.
Okay, thank you, Kano. Good evening. Can you hear me?
I can, sir.
Okay, thank you for the opportunity. Like, you're doing great. I've been following you since 2020 to 2023, hosting space with Olumide and Deco. You have been a blessing to me and also to individuals who is putting what you are teaching in the industry. It's not about asking questions, but it's just a compliment. You are genuine. What you are doing in this space is very fantastic. Is your space that I come encounter knowing about Facebook stock when it was trading around $100, but currently I think around 660, which I bought some shares and other ones, and also the insights about researching personal instruments about researching and other things that helps to young ones to position in the financial market. So my contribution is you are doing a great job, and what you are teaching, I'm putting all of them into execution, which is yielding a lot of profit for me and also to the investment category, researching some stocks and knowing how to navigate the financial market. So it's just a compliment. What you are doing is not only talking, but you are improving lives, and I'm one of them that you help in the industry, which I invested early, and I'm seeing the returns, both CleanSpark, Hot 8, they are just companies in America when they were trading at below $1, but go and check them now. CleanSpark is trading at $58, one is $10 off, but they were trading at 0.5, but because of the knowledge I got from your space, I researched and I got them earlier, which they are in my portfolio in Bamboo, which they are yielding a lot of returns that is imaginable. So I'm so happy for your space, and I'm following you back to back, and also You are doing a great job in the industry. Thank you, and God bless you.
Thank you, sir. I appreciate the comment. Really, really do. The best way you can support me is to also, let me give you a challenge, right? Maybe buy a book and give someone for free. Get one of my books and give someone for free so they can read and also try to catch. Most of the stuff I say here is in the book. I have a passion to educate about financial literature, so I want you to do that for me. That could be a good way for you to support me. Get the book, give someone for free so they also learn. So again, just to say this right, I'm a bit disappointed. I asked the ladies to come in and ask questions. I have not seen one lady come in to ask a question. You know, if I had done this space and I had charged 5,000 naira, I wouldn't have sitting room. You know that, right? If I had done this space and I said you're going to have to pay 5 grand and you're going to have to come listen to me, there will be no room. But maybe because it's free, so people are not coming. So maybe next time we'll make it paying only, and then that way we can get more participation. Yeah. Okay, guys. So yeah, we got Ebuka. I think we've spoken. I like spoken. Who hasn't spoken? Who hasn't spoken on DM? Let's make sure I read the DM so I get everyone in here, and then we'll let you guys. Yes. So someone is explaining that it's called VTSAX. That is correct. VTSAX is how it is usually called sometimes. That's the index fund. VTSAX is the index fund. On the ETF side, it's usually called the S&P 500 and all that. Yes. J.A. Collins. So yeah, that's the index fund, Toby. That's the index fund. But all these other ETFs track that index. The index is just the accumulation of all those stocks, right? Then you can have an ETF that will track and say, I'm going to replicate that index. So once you buy my ETF, you are buying the index. That's exactly what they are doing. So you can buy the VOO, the VTI. Let's say you want to buy all the stocks on earth, quote unquote, the good ones, right? You want to buy all the good stocks on earth. You just, whether it's US, Nigerian, American, you just buy VT. Just Google VT. That's all the stocks. South Korea, Nigeria. I don't think Nigeria is there, but South Korea, America, China, Japan, Canada is all going to be in that VT. Nigeria used to have an ETF it was called the MSCI Nigerian ETFs, where you could buy that particular ETF anywhere in the world, and then of course you are buying the Nigerian stock market. But they stopped it. That was under the former president, because the dollar was tight. They didn't want that people would buy and people want to sell, they can't get dollar. So they stopped it. So if the economy improves and we get more dollar circulation, perhaps they'll restart it. If they restart it, most of you guys can just buy that ETF and it replicates what's happening in Nigeria as well. So that's one of our hopes, that we can get that going. If it was MSCI that had it before, then it was stopped. So yeah, Toby, what's up?
Hi, I'm doing great. How are you doing?
Doing very well, sir.
I wanted to ask, can you talk about the psychology of human entirely when it comes to investing? It seems like we've been talking about this over and over and over for so many years, but then people still find it difficult to stay put, invest, dollar cost average, and then just keep buying.
Yeah.
And then people will, like, something flashes, like something very, very interesting, they go in search for it, buy it, and then it falls down, and then they all crash and come back again and start all over again.
Yeah.
What is that thing about the human mind that really, really beats our imagination and lets people just stay on one very proven strategy, buy it and let it just go? You have a lot of experience, spoke to a lot of people. Can you just help me understand?
Yeah, that's a great question. You know, in the Bible, there's this story in the Bible about, I forget the guy's name. He was the captain of the guard, and he went to Elisha. I don't want to kill my Bible studies here. The general went to Elisha and said, I have leprosy, and I want you to cure my leprosy. Even today, we know that leprosy is a very, very contagious disease. You know, if you have it, it's bad. You know, it was a leper. And when he went to the quote unquote to the sage, he says go take a bath 7 times. End of story. What's the story about? This is a simple thing to do. Go and think. It wasn't that the river would cure him, but his faith in listening to someone that knows what he's doing about was going to cure him. Warren Buffett has said, if you want to make money, buy an index fund. He didn't say trade. He said, take your money, your $1, buy an index fund, leave it alone. That's what Mr. Warren Buffett said. If you simply go by faith and do it, because it sounds so simple, we don't believe it. Same with the general guy. He didn't want to go to bed because he said, if Elisha had told him, bring 100 cows, they must be white. Then bring 100 pigeons, they must be black. Then kill them at exactly 11 o'clock and your leprosy will go. He would have done it, and he wanted something complicated, because in the human mind, if something is complicated, it's true. If it's simple, it's too simple. Everybody will do it. So on this space, we have close to 3,000 people that have joined this space. 3,000. I've said it again on this space. In 2020, 5 years ago or 6 years ago, right? We had this exact same space where we've told folks to go buy VTI. I never recommend, but I said, listen, if you are young, go buy VTI because it's an equity fund. You invest in America. Some people did it, some people did not do it. The guys that did it today are on a Telegram group. They are there. They're going to come out and they are there. They made 100% return. What they didn't trade, the entire group is buy, dollar cost average, don't sell, don't do anything. Just buy it, leave it alone. Rip Van Winkle portfolio. But people want something sexy. I want to buy crypto binary assets. Then I take a loan and I buy it, and then hopefully it gets to 10% and I sell. There is no profit in that. Investing is very boring and patient, and you have to follow the principles. What are the principles? Start early. Compound. Reinvest your dividends. Start early. Compound. Reinvest your dividends. That's it. There's nothing else to invest in. Start early, compound, reinvest your dividends. That's it. The rich are rich today because they have compounding. They compound their investments. What's a company? A company sells goods and does retained earnings, right? They compound. The tax laws tell a company, if you make a profit but you used funds to make that profit, will allow you not to pay tax on it. So they have an advantage inbuilt to compound profits. So the value of the company keeps on rising. Even when traders, if you trade in America and if you sell your portfolio within a year, the US government will tax you more than if you sell your portfolio after a year. So even the US government is telling you, don't trade. But we have day traders. So it's always a very, very good observation you bring about that. We want to do the complicated when the simple is right in front of us. And I've given you the pathway. If you're a Nigerian today, go and open up a retirement savings account. Why RSA? Why not bank account? Because RSA has tax advantages. Once you open that account, take money from your paycheck, put in that RSA. Because the RSA does automatic compounding for you. Invest in Fund 1 or Fund 2 that has a high equity composition. Leave that RSA alone. Contribute monthly, just leave it alone. When you retire, you're going to have more money than you put in. Someone's going to say, what about inflation? Yes, there's going to be a big inflation because the RSA, but stocks have beaten RSAs. RSA has beaten inflation in Nigeria because stocks have beaten inflation. So if you want to be more aggressive, do RSA, do a separate fund, then do what I'm saying. Go and buy NGX30. NGX30. That's the 30 biggest stocks in Nigeria. Buy them, put in that portfolio, reinvest your dividends. Leave it alone. If you want to do the American one, buy the S&P 500. So you buy VTI, you buy VOO, reinvest your dividends, leave it alone. 10 years, look at it, you won't have lost money. It's just really that simple, really. So the idea is compound if you are younger. If you are younger, compounding works for you. Once you get older, the effect of compounding no longer work for you. Then unfortunately, you have to take more risk because you missed out on compounding. You can't get your compounding back. It's like, if you don't train when you're young, you can't train today. You can't get 9 women pregnant and have a baby in 1 month. You have to have a baby born in 9 months. So you can't say, I'm going to increase the number of women and have the baby in 1 month. Doesn't work that way, if you know what I mean. Thanks, Toby. Appreciate that. Let's get Chisco. Toby, you have any more to add, or you're good?
I mean, if I have more space, I could chip in again. But,
yeah, go for it.
Let the other speaker.
Let's get Chisco in. Okay, after Chisco, go back to it. Chisco, what's up?
Yeah, I just want to say thank you for everything you have been doing for all of us on this Twitter. I've been following you for a very long time, but I have a little question I want to ask. I'm a little bit confused regarding U.S. stock, the dividends, the U.S. stock that pays dividends. Like we don't reside in U.S., I think we are charged 30%.
Yeah.
Yeah, tax. So do you still advise us to buy dividends paying stock or just normal stocks?
Now I'm asking you to buy the index, not even the stocks itself. Just buy the index and then reinvest the index. Yeah.
Okay.
Because I hear what you're saying. If you're not a US person, they will give you this W8, Abi. You do W8, Abi.
Yeah.
Yeah, do a W8. But when you pay, okay, it doesn't work that way. Okay, that's fine. But just buy the index because the returns on that index is more than the tax. Remember that they're taxing your dividend. But so reinvest the dividend. Reinvest the dividend. The portfolio itself is growing. The portfolio itself is growing because when you reinvest the dividends, your average cost falls. So if you buy the portfolio for $100, because you are reinvesting the dividends, your average cost is going down, even with the tax. Even with the tax. Makes sense, sir?
Yeah. Thank you.
I appreciate you, sir. Toby, want to come back?
Yeah, I really want to. I want to dive in a little bit deeper. I read your book a couple of times, gifted about 5 copies to young fellows around me as well. But there's this book, the one I asked on YouTube by J.L. Collins, The Simple Part of the World. And he really discussed about building an asset, multiplying your annual expenses by 25, and pulling out about 4%, supposing that the asset performs roughly about 7% per year, and then 3% discounted for inflation, and you pull out 4%. Can you break that down for us? Since you're talking about building wealth in really practical terms, so that we're not just talking about buying VTI and then just keep. Then at what point do you start really enjoying it? And we're talking about someone who is like 40 years now and who is starting out, and you're trying to build something until retirement, 25x your expenses, pulling out 4% also. Can you break it down for us in a very simple way?
Okay, so that 4% is this is a calculation used in America to say that when you have your portfolio, you can survive with withdrawing 4% a year. It's like a rule of thumb to say that whatever portfolio you have, if you withdraw 4%, you can survive on that 4% as income for the year. So if you walk to the answer, what they are saying is this: if you want to earn 10,000 naira every month in Nigeria or every year in Nigeria, what would you have invested that when you multiply that principal by 4%, it will give you that 10,000? You see how they are going about it? They've calculated that 4% from your portfolio keeps you going in your retirement. So walk back. as a 25-year-old, when you start working, you have very, very low income. Very, very low income. So you can't invest. That's when you take on debt. There are stages to invest. But let me start again. When you are younger, when you start working, you don't have any income potential. You just there to work. You have no income. You are expected to then take on debt to build your assets. What sort of debt? Mortgage, right? Even a car loan. So you buy your house with debt. What happens to the house? As you get older, you are paying off the house. That when you are retiring, the house is yours. You have built up that equity. Then you can sell the house or take a HELOC on the house and then live off the income from that house. Same thing with equity. When you are starting off, you have no money to invest vis-a-vis someone that has worked longer than you. Your income is low. Your salary is low. So the only way you can actually build an asset is to buy today and allow the process of time and discount and the DCA, when you're making your monthly payment into that portfolio, to build that portfolio for you. The idea is to build a portfolio that generates passive income that pays your expenses. The reason why we are all working is to generate passive income from our fixed income to pay our expenses. Fixed income is the active income you make when you are working. So Toby, let's say you're a doctor today. You are working today as a doctor to earn a salary, but your salary is active income. You've got to go to your office to create that active income. What we need to do is to convert that active income to passive income. So you take your salary, you buy a house, you buy stocks, and that house and the stock you have bought are going to allow you down the line generate passive income. Active income is not wealth. Better example, if you're a footballer, you play for Chelsea, you are being paid £100,000 a week. That's not wealth. That's simply active income. Your job is to convert that active income to passive income. So you take that £100,000, you buy property, you buy land, you buy shares. It starts to give you income today, very little. It can't pay your 4%. But down the line, those assets generate enough passive income to pay your expenses. If you are working today and you do a calculation and you have no passive income today and you are about to retire, I don't know the word to use, but you're in big trouble. Your salary is not the important element. It's the passive income you have built. If your salary stops today, where else will you get money from? Do you have a house that pays you rent? Do you have stock that pay you dividend? Do you have a business that pays you director's fees? What? Without that passive income, you're in big trouble. That's the point, Toby. That's your question you're asking. If you look at it that way, passive, active, 4%, it starts to make sense. All we're doing today is to show you how to get passive income. That's it. If you don't get passive income, you're in big trouble. And passive income is you have a house, it pays you rent, or it avoids you paying rent. So if you have a house, you live in that house. You're not paying rent, fantastic. That's also passive income because money is staying in your pocket. But if you don't have a house, you're paying rent, and you are retiring, you're in big trouble because your expenses would never stop, but your active income has stopped. And active income needs a long time to be converted to passive income. You and I know, Toby, the way we build homes in Nigeria is that we go and buy virgin land in a swamp. Isn't that how we build house in Nigeria? We don't have a mortgage. So if I live in Ikeja I'll go and buy land in one swamp, hoping that in 15 years they will build the road, people will start to move over there. Then I sell one plot, I fence it, I do foundation in 1 year. Next year they give me permission, I do fence, I do decking, that's how we build homes here. It's the exact same thing, that same principle of buying an asset in the future, then taking our active salary to build that home up. Because we know that when we retire in 20 years, that swamp we bought is now a big area. When I was growing up in Lagos stopped at Mobile. The Mobile exit, that was where Lagos stopped. Everything outside was a swamp. If you go on that road, you see crocodiles and monkeys after that Mobile. There was nothing from that Mobile down. There was a road. The road went all the way, but there was nothing on both sides. It was swamp and Atlantic Ocean. Go there today. It's the fastest growing area, I would even say, in the whole world. Folks that bought third roundabout, second roundabout, not first two, are today millionaires. They converted their active income to passive income. If you don't get that point, you won't really get it. That's why you are working to convert your active to passive. If you don't convert your active to passive, you're in big trouble. So we hope that helps.
Perfectly. Can I ask a follow-up question to that?
Yeah, good.
Since staying on the 4%, now, if the idea is to pull out 4% and survive on it per year, every year, would that 4% come from the dividend paid, or would you have to sell off some stocks?
No. Remember, the 4% is an American number. What they are saying is that when you have worked and built your portfolio, you've now retired. There's no more active income. You've now retired. So you have a portfolio of maybe your property, your social security payments, maybe your IRA. They are saying that what you withdraw from that portfolio, that 4%, should pay all your expenses and keep you alive. That's what they are saying, that when you do 4%, it allows you to survive on that portfolio. You can do 8, you can do 50 if you have enough money, but the 4% is the minimum cap. They are telling you that if you can just build a portfolio that can generate 4% for you annually for 25 years, you are fine. Remember, Americans live longer. They have good health care. So when they live longer, they need a portfolio that has to be there to pay their expenses. When we retire in Africa, we go to the village. We don't have expenses in the village. Remember, we don't pay power. We don't pay all that stuff in the village. Yes, we pay, but we don't pay the way an American is living in Florida in the retirement village is paying. So our expenses after retirement fall. But health care, what we don't take into account when we are young, becomes a big issue when we are older. Americans have Medicaid. We don't have Medicaid in Africa. So you have to look at it in terms of who you are talking to. If you are retired in America, you have a better chance than if you are retired in Africa, because of the medical care is taken over by the government. In Nigeria, you see what happens is your children are your medical medical fund. If you are sick, your children have to take you to hospital and pay for you. In America, there's Medicare, there's Medicaid that will take care of you. So that 4% is what they want to go to the cinema, to go for holidays. Open America, travel over the world, because they have a certain organized way where they spend money post-retirement. We don't in Africa. So you've got to build a portfolio that covers your income post-work. Many Nigerians don't buy health insurance, but they need it. When you stop working, we don't do NHIS. We think it's the government that's taking our money, but you need NHIS, because if you get sick in Nigeria and you are 70, who's going to pay? If you don't have kids in America, that's what usually happens. If you are sick, they send money, they take care of you. But if you don't have kids in America, who's going to pay for you if you're 70? So I hope that helps.
Yeah, clearly. Thank you very much.
If you are African, we're changing a bit in Africa right now. There is hardly a family today in Africa, let's just say Nigeria, that does not have a cousin or brother abroad. Those kids that went abroad, when they went abroad, if they went as a single person abroad, they still remember you in Africa. When they have kids, they're going to forget about you. Their kids are not going to be interested in sending money to Mama Ngozi in Nigeria. They're not going to be, because they have their own life there. So you're going to see that going forward, there's going to be a change in the demographics of Nigeria. We have a lot of old people in America that want to come back to Nigeria, but have no means to come back. What I mean no means, there's no security, there's no Medicare. But these guys have a lot of money, but they want to come back to Nigeria. If you have the means, if you know your state governor, you know your local government guy, and you can build a village for returnees, you can put a hospital there, put a golf course, put a lake, you will make more money from those retirees than from FARC. Because the cost of medical care in America, managed medical care in America, you guys know that it's about from $5,000 to about $15,000 per person. Which means if you live here and you need assisted care in a home, the state or the federal will pay per person between $5,000 to $15,000 per month. If they come to Nigeria, you offer them a bungalow, nurse on duty 24 hours, doctor on call 24 hours, golf course, lake, security, walking paths, exercise, Nollywood. You can do all this at less than 10 million naira in naira, but are being paid in dollars. If you can create that kind of community in Nigeria, wow, you're going to have lots of retirees coming back to Nigeria because their dollar would last them twice what last them in America. But in Nigeria, you don't have them lots on call. So instead of Medicaid, they're getting they're getting great medical care in Africa from medical doctors, from nurses that they can't afford in America. But in Nigeria, how much is their food? How much is their power? How much? So a state can do this. You can build a skyscraper or you can build a bungalow with a skill. And these guys will come in from America. They will come here. They will live. They want to die here. And you can bury them in a nice cemetery. And you are getting FDI like crazy, because the next thing going to happen is the American retirement homes will have to come to Nigeria and build retirement homes in Nigeria where they will send people here at half or quarter the price. That's a big business opportunity for anyone that's listening. If you can build that, people will come, because over here it's expensive. It's expensive. If you build something in Africa, Nigeria, where it's safe, quarter of the price. Yeah, look at the old people. What do they need? Constant care. That's it. Alright guys, we're going to go very soon, guys. Yeah, someone has recommended SCHD. Yes, SCHD is an ETF that is high dividends. So yes, that's another good one, SCHD. Remember, you got to invest based on your objective. If you want dividends, go and do that. But start with build a triangle. At the base of the triangle, build your VTR, your VOO, then start to work your way up and say, okay, I want dividends, I want tech, and all that, work your way up. But let the base be that solid US equities, blue chip, old money stocks, and you can't go wrong with that. Fantastic, guys. Let's call it today. Tons of questions. If you send a DM, of course, I'll answer. Don't ask for questions on the DM, ask on the general TL line, and I will definitely answer your question on the general TL line. We're here again. Oh my God, you guys. We're here again every Sunday, 7 p.m. We're always here to talk about money and investing. I thank you guys for listening. Like I said, this is going to be recorded. It's going to be recorded on YouTube. YouTube guys have been fantastic. Lots of them here listening in. It's going to be on YouTube. Also going to be on on the podcast as well, so you can go back and listen. And I've shared the slides also on Twitter. Anyone you don't understand, go to the slide, ask me a question, and I'll answer it. Most of all this stuff, guys, is in my book. I always plug my book because it's there. And I wrote that book with Nigeria in mind. So it's the same teachings that you see a J.L. Collins talk about, but with a Nigerian perspective. And I use Nigerian example. There's a whole chapter there where I analyze close to 20 equity funds. I'll tell you, if you want dividends, buy this equity fund. If you want this one, look at this one. Nigerian ETFs, not even foreign ones. There's VO there, but also Nigerian ones. Because there are a lot of Nigerian ETFs that guys don't hear about, right? So it's all there in the book. It's all there in the book. Try to get the book, get for yourself, get as a gift, send it out to someone. It's only available on Amazon for now. I think you bless someone with it. Right, guys? So fantastic. It's been a great session, especially I wanted. My only regret is I didn't get a lot of females coming in to ask questions. I don't know how. We will have to do a special space only for the females. I don't know who I'm going to use to beg them to come, but we definitely have got to beg them to come. Because wealth is built, and again, the guys don't hate me. When we do the exercises, right, women tend to be better investors than men. They say the reason is because women don't take risk. So it's a plus and a minus. But women don't take risk, so they tend to be able to manage their monies better than women. You don't see a lot of women doing gambling. They do, but you don't see a lot of them doing gambling or even crypto. But when MTN sold shares in Nigeria, women were almost double the amount of men that bought shares. So women understand investing, they understand buying shares. You don't see them doing two bets to beat one, Chelsea beat Tottenham, but you see them buying MTN shares. Which is why I wanted to come to the space and to essentially hear this and then just take it home, because I know if I speak to one woman, I speak to many women. So I really want you guys to do this. And if you're listening, I'm going to give you an offer. If you guys organize yourself, if you want to come as a guest speaker, I'll come. I won't charge you. As long as it's a women group, I'll come. I won't charge you. All right, fantastic. Guys, thank you so much for listening. I appreciate you guys. I hope I'll see you guys here next week. We're going to come again next week on Sunday, 7 p.m. West African time, where we again talk about on that issue. Till then, I'll let you guys go. If you guys have the time to tune in again this night, we're going to do Monday Morning Matters with me. We'll talk about a topical issue affecting the economy for the whole week. We'll try to do that on Monday mornings by 7 a.m. On your radio while you're traveling to work. We'll give just an overview of what's happening in Nigeria. On that note, guys, thank you so much. Toby, have a good one. I'll see you guys. You guys have a good one. Take care of yourselves, and we'll see. Bye.
Thank you very much. Thank you.
You're welcome.